We're entering dangerous territory. The U.S. debt crisis is no longer just a future concern, it's becoming a present reality. Since Trump took office, his administration has focused on preventing the debt from spiraling out of control. The strategy was to cut the deficit by reducing government spending. However, recent testimony from Treasury Secretary Bessent makes it clear there's no turning back. The wave of debt is already moving, and it can't be stopped. To avoid an outright default, the government will continue raising the debt ceiling and borrowing more money to pay bondholders. This avoids a technical default. But what we're seeing instead is a silent default. Inflation is quietly reducing the value of the debt. Borrowing isn't necessarily harmful if the economy grows faster than the interest on the debt. In that case, the country can manage. But the U.S. economy is facing difficulties. In the first quarter of the year, GDP shrank by 0.3%. The second quarter is projected to grow by 2.3%, but that estimate is based on limited data and still doesn't meet the necessary pace. At the same time, borrowing costs are rising quickly, reaching unsustainable levels. Even with recent easing of tensions with China, investors remain uneasy. They observe the weakening dollar, increasing U.S. borrowing, and ongoing economic harm from tariffs. The 10-year Treasury yield rising above 4.5% is a serious warning. For months, rates stayed below that level, but now they've surged, showing the market is struggling to absorb the flood of U.S. debt. Plans to cut government spending have fallen far short. Instead of achieving the proposed $2 trillion in cuts, the actual reductions are closer to just $100 billion. This gap is raising serious concerns. Currency expert Stephen Jin has warned of a possible bond market collapse that could require a full reset of the system. This situation is similar to what happened in the UK during the Liz Truss crisis, where large tax cuts without corresponding spending cuts triggered a bond market meltdown. Trump's approach seems very similar, and revenue from tariffs won't be enough to cover the massive deficit. If investor confidence falls and they begin selling long-term bonds, yields could spike dramatically. In the UK, yields rose by 1.5 percentage points, affecting everything from mortgages to car loans. If this happens in the U.S., the consequences could be severe. Trump's usual strategy of pausing tariffs to calm markets isn't having the same effect. The situation remains tense, with only a temporary pause in trade issues with China. Investors are frustrated, especially because Trump's tax cuts have increased the debt significantly without matching spending reductions. Recent tax laws could add $3.3 trillion to the national debt by 2034. That means around $330 billion in bond sales every year for the next 10 years, pushing the budget deficit to 7% of GDP. Investors are pushing back, demanding higher yields to offset the growing risk. The 30-year Treasury yield has recently climbed above 5%, a clear sign that the market sees the U.S. debt as unsustainable. We're on a collision course. High government spending colliding with an economy weakened by tariffs and uncertainty. A storm is forming, and its effects will be felt throughout the economy. Picture a scenario where more money chases fewer goods, and input costs like materials, labor, and energy keep rising. This isn't some distant event, it's the direction we're heading. When that happens, it's not just inflation. It's structural inflation. This kind of inflation isn't easily reduced by a slowing economy or small adjustments. It affects every part of the system, making prices consistently high in everyday life more expensive. Now imagine being a foreign investor looking at U.S. bonds. What was once a reliable safe haven, the foundation of global finance, no longer offers security. With inflation eating into returns, investing in U.S. bonds now means accepting real losses. The dollar, once seen as untouchable, is now weakening, dropping significantly against all major currencies. This isn't just a slight decline. It's a steep fall. Look at the numbers. European investors holding U.S. debt have lost 8.3% on their dollar assets. British and Japanese investors have each seen losses of at least 6% in their own currencies. These aren't minor tremors. They're earthquakes shaking the foundation of global finance, and no surprise that foreign investors are fleeing. This massive sell-off is pushing bond yields through the roof. And as yields rise, borrowing costs skyrocket. Demand for U.S. debt is disappearing quickly, like water in a furnace. How is the government responding? Instead of facing the hard truth and cutting deficit spending, they're throwing desperate, untested ideas at the wall. Bessent is scrambling to boost demand for U.S. assets by any means necessary. But these are only temporary illusions hiding a much deeper crisis that let's suppose, for a moment, that Besson is completely right. Imagine all the money from stablecoins flows into U.S. treasuries, creating a huge $2 trillion in demand. That might sound like salvation. But here's the problem. The government is spending nearly $2 trillion each year. That means all this new demand is simply being absorbed by the government's massive appetite, that there's no way out without major cuts. If this bond market collapse continues, the Federal Reserve will face an impossible decision. Intervene by printing large amounts of money to buy U.S. bonds and create artificial demand through quantitative easing again. This might calm markets for a while, but it would damage the dollar's value. Confidence will collapse. The consequences will be severe that if you thought the last market crash was bad, get ready for what's coming. Trust will fall below zero. Savers and bondholders will suffer the most, watching their purchasing power vanish, sacrificed in a desperate attempt to save the system. Once the dust settles, asset prices will soar, not because those assets gained real value, but because the dollar itself has collapsed. This marks the beginning of a new economic battleground, where the U.S. dollar weakens consistently and inflation sticks around like a ghost that won't go away. The idea of keeping inflation under 2% is already dead. This may sound like a disaster scenario, but we're speeding toward it every day. Like Janet Yellen before him, Besson is stuck on a runaway train with no brakes. Unable to stop a financial system headed for crisis. To fix it, he'd have to cut major spending, defense, social programs. But politics makes that nearly impossible. Trump's big plans are blocking serious reforms. By 2029, U.S. debt will exceed 106% of GDP, setting records and driving interest payments higher. Unless rates drop, that we're facing regular debt scares, shaking markets every quarter or even monthly. The U.S. faces a tough, unavoidable choice. Protect the dollar's strength or protect the financial system. It can't do both. Something must give, and the dollar is likely to be sacrificed. Bondholders and savers in U.S. dollars will be the biggest losers once again. Meanwhile, American investors are missing out on one of the century's biggest wealth-building opportunities: China's rapid growth. Look at CL, the Chinese company planning an IPO, originally targeting $4 billion. Investor demand has raised that to $5.3 billion, supported by retail investors and major institutions like China's state-owned oil giant SOP and Kuwait's sovereign wealth fund. Among 2025 IPOs, CL is set to dominate, raising nearly as much as all U.S. companies combined. This shows that China's leadership in electric vehicles is now extending into global financial markets. Beijing no longer needs Western capital to grow its companies. Instead, China is turning to its domestic market and the global south, especially in Asia, to raise billions, cutting its financial ties to Washington. Chinese companies used to go to New York to list. Not anymore. Regulations, geopolitical tensions, and risks from Besson's policies have pushed them toward Hong Kong listings instead. Despite U.S. blacklists and tariffs over 100%, Chinese battery makers dominate the market. CL alone controls nearly 38% of the global EV battery market, and with BYD, China controls over half. EV manufacturers around the world are facing a